War rages on in the Middle East. You got inflation ticking up again, and you got dollar stuck in a tight range. Welcome everyone to the 10th episode of Macro Monday. In today's episode, I'm going to cover my view on the current geopolitical situation. I'm also going to share a trade of the week, which I'm already in with my traders. I'm going to give you some insight on that. A little bit late, but rather late than never. But I'm going to run through that in this episode. So sit back, relax, get a notebook and a pen, and let's jump straight into the video. Right, what's going on everyone? Happy Monday. Hope you're good. Dollar is stuck in an awful range. So if you have been trading for the first 2 weeks of the year, you would have definitely witnessed intraday price action. So I'd like to just remind you, today is a bank holiday in the United States. It is Martin Luther King Jr. Day. So go ahead and enjoy your day. Don't sit there staring at the screen, because we are going to have a lot quieter volume in markets. But biggest story raging on right now is the constant threat of further escalation in the East. Last week, we had the US and the UK form an alliance to go ahead and target the Houthis. Now, who are the Houthis or the Houthis, if I'm pronouncing it correctly? The Houthis, for the purpose of this video, I'm going to say Houthis. Rolls of the tongue a bit better for me. The Houthis are a military group in Yemen. They are Iran-backed and Iran-funded. They have been firing and targeting missiles against ships in the Red Sea. Now, that is purely their form of retaliation for what is happening in Palestine, in Gaza. So with that said, they've put a statement out. They will continue firing against ships in the in the Red Sea, in the Middle East, until a ceasefire comes to wrap in Gaza, which I really hope it does. I do think this has gone on way too long now, and we definitely do need to urge for peace. However, we are where we are, and in terms of trading, it's important that we understand what is actually going on. There is threats of Russia ramping up their fight against Ukraine. You've got Germany and Sweden gearing up for further Russian escalation. You've got China threatening to invade Taiwan again, and you've got Sleepy Joe at the wheel. And yeah, I don't know what to say. I don't know what to say. Got 2024 elections coming up as well. So there's a lot to trade. There's a lot to manage. But we are officially through the midway point of January, right? I know it has been a slow start, but volume is starting to pick up. So it's going to be pretty good. Without further ado, what you're all waiting for, the chart. So let's jump onto the chart. So dollar, as I mentioned, and I'll just quickly run through if you're new to the channel and you haven't watched last week's episode. Dollar had a good squeeze over the festive period. Now, the squeeze over the festive period was down to markets pricing in that dovish Fed, markets pricing in the pause, markets pricing in the fact that 4 rate cuts were already being expected for the Fed. And that change in tone from the Fed really priced into markets. So if there was no news often is good news. But in this case, dollar really got sold over the festive period because there was nothing else. Right? There was nothing else. And if there is nothing else, markets will run with the last story that they had. So squeezed to the downside over the festive period. And we obviously had that recovery on dollar. Dollar's stuck in a bit of a range now. Now, how I see this is a bit of a cup and shoulder, a cup and handle pattern, if you want to call it that. And inverse head and shoulders, where you've had that squeeze lower, we've had that impulsive move higher, and now we are resting in a tight range. For myself, I remain bullish. Obviously, take this with a pinch of salt and put my view, in the rear view mirror for yourself. Really just think about what you feel and what you favor when you are trading. But for myself, what I'm going to be trading, I favor dollar trading higher. I favor the fact that this most recent spike higher in US inflation really warrants a bit more of a hawkish Fed, and it warrants the market repricing some expectations on what the Fed have recently been saying, right? What the Fed have recently been saying, and I really need to hit the nail on the head there. The escalation in the Red Sea is going to drive further delays. I mentioned it in last week's video. The current escalation in the Red Sea is causing a 2-week delay on the shipping routes. So instead of going through the Suez Canal, shipping containers and cargo ships need to go via Cape of Good Hope, right? Good old South Africa. via Cape of Good Hope, which takes an extra 2 weeks. So you want to try and keep that in mind. So yeah, I feel that's going to drive more inflation, and hence my current trade that I'm actually in. So I'm actually long on oil at the moment. I'm long from about 71.50. I actually draw my risk reward on. I was at the gym at the time of entering the position, 71.52. I'm looking for $74 a barrel. I feel that is good enough of a target for oil. I have my stops at 71, right, on oil. I do like the risk. I like it from where it is. I'm roughly, I was at 1.01 to 1. But I like this higher. Why do I like this higher? The escalation in the Middle East, in my opinion, is going to warrant oil, gold, silver, all trading higher. I understand it is a bank holiday today in the US, so volume will be a bit slower. But I'd like to see this trading higher. We have also, if you look on the 4 hour and the daily, you've really been stuck in an awful range on oil. Now, this is purely been because you've got the global slowdown trade, which warrants you selling rallies. But then you have the escalation in the Middle East, the ongoing war, which will warrant buying dips. So you got to choose what suits your fancy. But for myself right now, I favor it trading higher, and I favor these dips getting bought. So we are currently, in my opinion, finding a bit of a level of support. We are finding a low, and I favor buying dips on this. Alternatively, what you could do, if you do favor a bit more of a safer trade, trade the retest of 73. Right, so if you look at this on the lower time frame, there clearly is a bearish structural play going on here. So a safer trade in that sense is waiting for the break and waiting for any retest, whether that retest may be, and then jumping on the back of that move there higher. So choose your, obviously, whatever you favor. I favor an initial entry from where I am, and I'd like to scale into the position should we break 72.50, 73. But understand that oil is a tough manage to trade. It is not your friend. It is extremely volatile. So do please keep that in mind. And obviously, this is not financial advice. This is just a trade I'm putting onto the market. I'm already in, and a trade I'd like to scale into. Something else, looking at euro dollar. There again as well, stuck in an awful range because dollar's range bound. Why is dollar range bound? There hasn't been much Fed commentary. Despite the most recent uptick in US inflation, you've had Mester, you've had Bostic, but we haven't had a full panel of Fed speakers commenting on inflation. A lot of them are still going to remain data dependent. Don't just think because we've had one print, you know, everyone's going to turn the ship around and start talking about further hikes. But do expect a higher for longer attitude, in my opinion, which could unwind some of this pressure that we had over the festive period. A good level for me, and where I do see dollar over the next few weeks, especially into February and so forth, 105. I see the dollar back at 105, right? So if you look at that, you can say, okay, I have 103 and I have 102. If we do trade higher, great. You can focus on buying dollar dips, which would be selling euro dollar rallies. Alternatively, if we do have that dovish Fed price back into markets, we could see a crack below 102. You can sell any rally into 102 intraday. But I got to be honest with you, I'm leaning more towards dollar trading higher. You got dollar yen there. Was my first trade of 2024. Was buying dollar yen down here at 143.70. I think it was 143.75. Obviously, could have held that for a lot longer than what I did at the time. Right at the time, I thought we would have had another retest into 144, where I would obviously have thrown some size back into that position. But on Friday, I put an alert out in my mentorship to be buying dollar yen dips from 144.500. We tapped straight into 144.50, and we obviously had that move higher. There again, folks, looking at this, I favor this trading higher still. So if we do get any dips on dollar yen, I do feel 145.35, not 143, 145.35 for some longs there. 147 ultimate target with a 35 pip stop, 40 pip stop, whatever you feel most relevant, given the reversal first and jumping on the back of it thereafter. I do think we could extend 147. Ultimately, if we have that move on the dollar index to 105, I expect dollar yen to unwind a lot of what it's done over the festive period there as well. 150 dollar yen, right? The Bank of Japan have done nothing. If we do slowly but surely unwind what the markets have priced in for the Fed, I do think there's a lot of room on dollar yen to the upside. So I'm not going to share everything with you. Go ahead and click the link down below. I've left the mentorship website link if you want to apply for the mentorship. I don't accept people all the time. However, I do check the applications every day, and once a month we have a fresh intake of new traders. So if you want to trade live with me every single day and a community of traders that I've been building over the past 14 months globally, go ahead and click the link down below. Small, quick little form. Tell me a little bit more about yourself. And if you have been successful, then I will be emailing you to join. This is not a one shoe fits all. So think about that when you are applying. But that's it, right? I like oil. I'm happy I got in where I did. I'm going to hold this, right? I'm happy with the risk that I have in place. I may roll my stops to 71.20 at some point just to reduce my risk, to trail my stops higher. But if we break 72.50, if we break 73, I want to throw some more size on. But that's it, right? Episode number 10. Thank you so much for watching till now. If you have watched till now, drop a thumbs up down below. Do subscribe to the channel. More importantly, drop a comment down below if you enjoyed this Macro Monday. And I'll see you guys on Thursday. I have a scheduled upload on Thursday. And Macro Monday again next week. Take care. Trade safe. Please remember what I shared today is not financial advice. It's purely what I'm going to be doing with my own money. And yeah, manage your risk. Trade safe. Pray for peace. Keep well. I'll see you next week Monday. Peace out.